The coronavirus outbreak has significantly disrupted every economy around the world in the short 6 months since its first case was discovered. The virus has left everyone with uncertainty about the future as they cut down personal consumption and the stock market becomes more and more volatile. As of now, there are over 7.5 million coronavirus cases around the world, with about 27% of those cases occurring in the United States, putting a strain on both foreign and domestic labor and production. Real GDP is estimated to have dropped about 4.8% at an annual rate in the first 3 months of 2020, which is the first decline in US GDP since 2014. The services sector played a heavy hand in the decline of overall GDP, contributing to negative 5 percentage points. This is because households heavily restricted their consumption of healthcare services, recreation, transportation, and food services and accommodation. The Labor Department recorded an unprecedented surge in unemployment claims, with 44 million people having filed for benefits since mid-March. This is 10 times the peak that we saw during the Great Recession. The unemployment rate reached a high of 14.7% in April, and it currently sits at 13.3%, with predictions from the Congressional Budget Office for the rate to stay in the double digits throughout 2020 and 2021. Before the coronavirus outbreak, unemployment benefits were handled at a state level. Each state has its own eligibility requirements for the benefits, and the amount of money varies depending on the state a person lives in. There are two primary requirements, the first being that the person must meet a certain threshold for previously earned wages or a duration of time previously worked. The state benefits also require that the person become unemployed at no fault of their own, meaning their employer laid them off for reasons that were out of the worker's control, such as increased costs in business along with decrease in revenue. On average, the state unemployment benefits replace 1/2 of a worker's previously earned wages, which incentivizes them to continue to search for new employment. These state benefits also require what is known as a 7-day waiting period, where the person does not receive any benefits for the first week after that claim.
So now, I would like to present about the unemployment insurance after the outbreak of coronavirus. Congress has passed CARES Act, which means the Coronavirus Aid, Relief, and Economic Security Act, and the President signed into law on March 27th. This over 2 trillion economic relief package delivers on the government's commitment to protecting the people from the economic impacts of coronavirus. And when we look at the unemployment insurance part, the act has expanded benefits further, including first, expanded range of eligibility. The top box with green highlighted in this slide is one of the clear examples that explain this range has expanded. That now it allows freelancers and self-employed and so on. Second, all unemployed workers to receive an extra $600 a week, and this has projected until the end of July. Third, unemployed workers to get an extra 13 weeks of benefits. Let's say in usual, the state of California allows the unemployers to collect up to 26 weeks of benefits, but now it says we can receive up to 39 weeks. Lastly, many states are waiting for the 7-day waiting period to be approved. And the next slide talks about the new policy debate, where some senators argue to extend the additional boost of $600 per week until the end of January 2021. And this proposal is included in a part of HEROES Act, which means the Health and Economic Recovery Omnibus Emergency Solutions Act. And this HEROES Act was passed by the House of Representatives earlier in May. However, some Republican senators do not want this extension to be part of it. They partially agree on the HEROES Act, but not the part of $600 extension. One main reason is that additional benefits could deter unemployed workers from looking for work. The United States Republican Senator Lindsey Graham said that if a person is making $23 an hour on unemployment, it's going to be hard to get you go back to work for $17 per hour job.
There are certainly many reasons that lawmakers should consider extending the federal pandemic unemployment composition, and one reason being that the timeline for economic recovery is highly uncertain. The virus will certainly still be here after July 31st, and negative economic impacts will persist for quite a long time. And because there has been no way to end the COVID 19 medically, there could be further breakouts in the future, and we may expect to see repeated openings and closing of the economies and so on. Also, as it is seen globally, the economic activities, they do not recover right away. And for example, in China, the consumer confidence remains very low after reopening the economy, and the factories are facing a hard time due to the canceled orders globally. And we expect US workers will be facing the same problem in the future. And the second reason is that the low income populations are disproportionately hurt by the pandemic. One reason is because the lower paying jobs are more concentrated in the so-called highly exposed industries. These include hospitality, retail, and manufacturing. These industries are more likely to face the shutdown policy in the pandemic. Also, according to the US Bureau of Labor Statistics, the populations of these highly exposed industries are disproportionately composed of those who are ethnic minorities, those who are less educated, and women. That's why we think extending the unemployment benefits will help them mitigate the economic burdens because it may be very hard for them to find an alternative employment. And lastly, as many students have discussed on backpack, the pandemic really exposed our society's pre-existing disparity, whether it's health condition or economic. That's why we think extending the federal pandemic payments is economically necessary as well as politically pragmatic.
There are a couple reasons that some people have brought up against extending unemployment benefits, and the main one of these is that these benefits would potentially discourage some people from going back to work because these benefits only exist for those who are unemployed. This is the main argument of the Republicans, who are mostly all against extending the benefits. The Finance Committee Chairman, Senator Chuck Grassley, who is one of these Republicans, says that in the quote that these unemployment benefits discourage people from getting new jobs, which delays economic recovery. Part of that reason is that a lot of people are actually making more money off these benefits than they would get if they went back to work. The Congressional Budget Office, or CBO, estimates that 80% of people would get more money through these benefits if they were extended rather than working. The chart to the right shows some of the data on approximately what percent of people are currently getting more money off the benefits than working, and it seems to be a pretty significant amount for pretty much every state, like 30 to 40% of people on average. There have also been reports from some employers saying that there has been low amount of applicants to job openings recently. Although this might be for many reasons, the unemployment benefits might be one of the factors. Another reason why many Republicans tend to favor not extending unemployment benefits is because of the November elections coming up. Since Republicans have more incumbents than Democrats, the Republicans want a lower unemployment rate so that they have an easier time to get reelected, since extending these benefits would seem to not decrease the unemployment rate as much as just making people go back to work and stop relying on these benefits. Another common reason that people don't want to extend benefits is because it is very costly to the government budget and to the overall economy in the long run. Again, it's mostly the Republicans who suggest this, saying that the $2.2 billion spent on the CARES Act, which basically provides financial assistance to families and businesses, is enough. They want to take a step back and wait to see the effects of this money before pouring in more funds to help with unemployment. Because this is turning out to be more expensive than people thought, and no one really knows for sure when this coronavirus pandemic will end. On the right, there's a quote by the Congressional Budget Office, which says that Funding the additional unemployment benefits would, however, increase the federal budget deficit. In CBO's assessment, larger deficits tend to slow the growth of the economy in the long term, thereby reducing overall income and the consumption of goods and services in the future. So this basically says that based on their study and analysis, the CBO expect that putting more money into unemployment benefits would be harmful to the economy because it increases the federal budget deficit by so much, and this in turn delays recovery because it reduces income and consumption in the future. There are also some reports showing that unemployment is actually decreasing as more people are returning to work, so there's no need to put much more money into these benefits. It said that the unemployment rate dropped to 13.3% in May and might continue to go down. But these things are still uncertain, so it's only a speculation. However, as of the past week, some Republicans are beginning to switch on their position regarding extending unemployment benefits. Some of them see the need for a compromise, saying that perhaps we just need to decrease the benefits, like instead of giving $600 weekly, now it should be $450 instead. So in general, as time passes, we may see different opinions on the benefits begin to change or switch, but for now, these are the two main arguments against extending the benefits. The first argument is how some people are taking advantage of them and not going back to work, and the second is that they're too expensive to continue.
So as you can see to the left, the graph on the left compares the two recessions by looking at the number of weekly initial unemployment claims. The current economic contraction caused by the coronavirus pandemic does not only appear to be larger than the Great Recession, but is also unfolding much more quickly. In 2008 and 2009, about 52 million people claimed unemployment benefits at some point, averaging to about 500,000 claims per week. The unemployment rate peaked at 10% in October of 2009. By comparison, 22 million Americans have filed for unemployment benefits in just 4 weeks between April and March, an average of more than 5 million jobs per week. 5 million claims per week, and few have found new jobs. Experts also believe that the unemployment rate for this quarter will total somewhere between 13 and 20%, levels that could be looking more like the Great Depression. And the graph on the right compares the fiscal responses of the two recessions. So far, the federal government has spent about as much money to support the economy during the current crisis as it did during the whole Great Recession. Between 2008 and 2012, the federal government enacted about $1.8 trillion of fiscal stimulus and other economic support. This time around, the federal government has responded in a much more expedient and dramatic fashion, passing more than $2.3 trillion in new stimulus measures just over the course of a few weeks. These measures have included direct payments to individuals, a significant expansion of unemployment benefits, loans and grants to businesses for the purpose of maintaining payroll, as well as aid to states and specific allocations to various other industries. And if we go to the next slide. So during the Great Recession, the Congress enacted several significant temporary federal expansions of unemployment insurance known as the Emergency Unemployment Compensation, or EUC, with additional tiers of benefits to supplement regular state unemployment insurance and extended benefits, or EB programs. Together, these programs provided up to 99 weeks of unemployment benefits to help jobless workers and their families. In the Recovery Act of 2009, Congress also boosted weekly benefit amounts for people with dependent children. Many states also expanded eligibility and improved access to unemployment insurance benefits. Altogether, as you can see by the numbers here, these programs and initiatives made unemployment insurance probably the most effective policy response to the Great Recession. Based on the data, you could see the benefits helped 24 million unemployed workers and helped support 69 million people. All of the programs together prevented millions from falling into poverty and even lifted 2.5 million people out of poverty. The benefits prevented businesses from shutting down, and it closed nearly 1/5 of the shortfall in GDP during the last recession. And in 2009, it saved 2 million jobs.
So when we're thinking about the effects on the American economy of this proposal to extend the enhanced unemployment benefits past July, there are two main kind of categories that we think of. So the first is the effect on consumption. which one of the main arguments for the proposal is that it will continue to maintain this relatively high level of consumption that people are able to get through unemployment insurance. And as far as consumption goes, especially when unemployment is high and liquidity constraints bind, there is a high marginal propensity to consume. And the Federal Reserve Bank of San Francisco found that similar to the Great Recession, there's a strong body of evidence that supports the claim that unemployment benefits produce at least a dollar for dollar boost in consumption. And the second category that we need to look at is this effect of adverse incentives, specifically in getting people back to work in order to stabilize the economy in time. And what has been found is that adverse incentives likely aren't as much of a concern as one might think, or aren't as much of a concern as a lot of these Republican legislators might think. So 44% of U.S. unemployment applicants have been denied or are still waiting to receive their benefits. And Gary Burtless, in his testimony for the Senate Committee on Finance during the Great Recession, this was given in September 2009, expressed that when unemployment is high and the number of job seekers greatly exceeds the number of job openings, adverse incentives are not terribly concerning. Going along with that, it's important to consider that these enhanced benefits increase a worker's capacity to reject bad jobs and find better ones. And this leads to an increase in the quality of matches between an individual's qualifications and employment opportunities, as well as boosting the overall productivity. So at this point, it's impossible to say with absolute certainty what the effects on the American economy are going to be from this proposal, but it's likely that the positives will outweigh the negatives in extending the enhanced unemployment benefits past July 31st.